Hello and welcome to Moving Iron Podcast Tax Moves with Glen now part of the Global Ag Network. And check them out at www.globalagnetwork.com. Glenn, welcome to the show, man. How you been?
Hey, Casey, good. Just getting ready for Thanksgiving
I
here.
hear you,
So,
man. I hear you. What is the? So we're getting ready. We're starting up here, getting ready to talk about what we're going to go. And you brought up retirement plans, which is a pretty timely topic here. Now we're talking about tax stuff for the last couple of weeks, and now we're going to move into some retirement planning and what that looks like. And there's always tax issues that come along with that. So you brought up a pretty good one that I hadn't heard of, called defined benefit plans, and how that works. So why don't you run that down for us?
So we've talked the last few times about, different ways to, defer income, accelerate expenses, right, to kind of manage our taxable income. So one of them that we haven't talked about yet is a retirement plan, right? So you can, we're going to primarily talk about self-employed people, although you can do this with wages too. But, so basically you could fund your own retirement and contribute money, right, into your retirement account. You don't have to pay income tax on it, right? So you kind of get the tax deduction this year. Now, later on, when you retire and you have to pull that money out, then it's taxed at that time. So that's what we call, it's tax deferred, right? This is not a permanent tax deferral. It's just we can avoid the tax right now, just later on when we're retired, and hopefully we're in a lower tax bracket when we're retired. Potentially that's a smarter move, get taxed on it at that time. So that's what we're going to talk about today, just some different options.
Okay.
Probably the most common one for self-employed farmers that I deal with is called a SEP plan. It's a simplified employee pension, and that one is entirely an employer contribution, and it's basically it's pretty much going to be 20% of your Schedule F net income. You can contribute that. So simple math. If I make $100,000 on my Schedule F, I can contribute $20,000 to the SEP plan. I'm only going to actually then be taxed on $80,000 of my income. So that's that $20,000 deduction. And then I do not have to make that contribution actually until the due date of my tax return. So basically I can actually make this decision, next March, next April, which is kind of nice, right? Depending on, where my income's at. So it gives me flexibility. So again, it's 20% of Schedule F income. The maximum is $55,000, and you do generally then have to do the same amount. If you do have an employee, you'd have to do that same amount. So if you're doing, 20% of your income, you have to contribute, 20% of employee income. So that can be a little tricky, but that's one of the big things to remember is there's a lot of rules around discrimination and test. The IRS looks at things and wants to kind of make sure you're treating, your employees fairly. So you got to keep that in mind. Now, with the SEP plan, generally speaking, the employee has got to be with you 3 years. So, the first year, the first 2 years you have an employee, you actually don't have to make a contribution. So, again, it gets complicated. You definitely want to talk to, a tax advisor on this. But just know that you can, defer up to about 20% of your Schedule F income, up to $55,000. There's also a 401k plan, and that's a little more common, in the business world for employees. Generally, they're just more forms, more hoops to jump through. You can do what's called a solo 401k, meaning it's just yourself. You don't have any employees. The amounts can generally just be a little bit higher for a 401k, but not really too much different than a SEP plan. But generally, you can just make a little bit higher contributions. You have both employee deferrals and you have the employer contributions. So, but there are more rules to deal with on 401k plans. But again, I would say most of my farmer clients probably have a SEP plan. Okay, so now we're going to talk about what you kind of led into, Casey, was this defined benefit plan, and it's really kind of a hybrid plan. It's called a cash balance plan. Okay, now this works really pretty well with a 401k plan, but this really gets complicated. Okay, you have to involve actuaries, and they got to do all sorts of calculations. There's more forms, more hoops to jump. But I just want to kind of give, the listeners today just some ideas, and you can check it out on your own. But the concept here is that it's a defined benefit plan, which means, the big thing here is the older that the person is and the more money that they make, you can actually fund a much bigger contribution than just the $55,000. Because the concept is, okay, well, if this person is going to be retiring in 5 years and we've agreed, pay him a certain amount of money for, 10 years out of retirement, right? And I don't have much funded, it's kind of like some of the government issues, right? If there's these unfunded pensions, with the state government. If I don't have much funded, then the actuaries basically can let me make a pretty large contribution, right, in order to get my funding level caught up. So instead of doing, $55,000, potentially you could, be able to do like $200,000, $250,000. I mean, these are big numbers. Again, you've got to run the numbers. The other employees, if they're younger than you, you don't have to make near as much of a contribution. So it has potential for a farmer. Let's just say, they don't have any employees and they're nearing retirement. You've generally got to make a 3 or 5 year commitment on this. So you don't want to do this like the last year you're farming, but potentially you can shelter a lot of income, a lot more than, the $55,000. And you might say, well, yeah, I don't have that much, not making that much money currently right now, and that's generally true, obviously, with, prices and things. But many farmers have a lot of grain that they've carried over for many, many years. They've deferred that. And so there's a lot of earned income sitting there that's going to be taxed. So you pretty much know, hey, even if I don't make any more money on my farm for the next few years, if I kind of break even, I still have $1 million of grain on hand, or $1.5 million. And that's the source of the earned income from which to be able to fund a cash balance plan.
Okay. All right. So you're saying, like, I'm sure I understand this right. So if I am a young guy going in and I'm going to buy out another farmer or whatever, I'm going to expand my farm, and this guy's retiring, so instead of just cutting him a check for $1 million, I do something over 5 or 6 years, $200,000 a year over 5 years, and you can put that into this plan. Is that, if I understand that right?
I haven't generally seen it in that light. Again, usually we're talking about, the older farmer, the farmer that's near retirement, and they just, it's their income. They've earned that grain, right? It's their grain. They just haven't reported on their tax return.
Oh, okay.
And so they're in charge here. And so, hey, instead of having to report all this income on your tax return, you can make a very large retirement plan contribution to defer that. Again, you eventually are going to pay tax on it.
Right.
And even if you die, just to keep in mind, these retirement plan assets are one of the few assets that you don't get a step-up basis on. So if I own land and I bought it for $1,000 an acre, now it's worth $10,000 an acre. Right? If I die, my heirs are going to inherit that and likely get a step-up basis. And if they sell the land the next day for $10,000, they won't owe any income tax. Okay. If I have $1 million money in my retirement account and I die, it goes to my heirs, but you do not get a step up in basis, and they have to pull it out over their lifetime, and so they're going to pick up this income eventually. So this is just a deferral gain. You will eventually have to recognize this as income, but instead of getting hit with this real big tax liability, hey, why don't I maybe consider, if I can fund it, right? I got to have the cash flow. If I've got lines of credit and other debt, maybe I can't fund this retirement plan, but if I can fund it, got to run the math, but it could be a good way to defer that income and not have to pull it out for, another 20, 30 years. So that money's working for you that time.
Yep. Rolling the dice that tax rates are going to be a little less or maybe the same or something like that down the road.
I was going to actually bring that up. I mean, in 2018, 2019, 2020, we feel pretty comfortable that the rates aren't going to change. But generally speaking, we've got some pretty low rates right now. So you could make an argument that, is this the best time to fund a retirement plan? Because you're not maybe getting quite as big a bang for your buck, right, if rates are low right now. But yeah, we've got to have our crystal ball and figure out what our tax rate's going to be, 10 years from now, 15 years from now. It's hard to tell. So just know that if you can do more than the set plan, the 55,000, it's, you don't have to go up near as high, to $250,000. You don't have to do that much. But it's an interesting option for people that are nearing retirement, because again, you can fund it so heavily those last few years, but it does come at a cost. There's complexity, there's forms to fill out, there's actuaries. So you don't want to go into this lightly. You got to make sure you understand it.
So with that, the question I have came to mind here. So if I do this, let's say I put, I'm retiring this year and I sold a bunch of grain or whatever, and I put a couple $100,000 into this plan like you're talking about. Does it show up when I do my accounting and the actual paperwork? Does it show up that I have $200,000 less worth of income, therefore I'd have a potential loss on the farm? Is that how that would work, or is that?
Good question. So the one thing I haven't mentioned yet is this retirement plan contribution for yourself. Again, let's assume you're self-employed. It is a deduction for income tax purposes, but it's not a deduction for self-employment tax purposes. So you will have to pay self-employment tax on it. But generally speaking, that ends up being about 3% once your income goes over about $130,000. So it's not like 15% if your income is below that. But to answer your question, this deduction wouldn't actually show up on your Schedule F. It actually shows up on page 1 of your 1040. So your Schedule F would not show your personal contribution. But if you were looking at just an income statement that you wanted to give your banker, it would be an expense. And so you'd have, you obviously explain that to your banker. But typically you're not going to be able to show a loss overall, because you have to have earned income in order to make this contribution, right? Remember that scenario, that set plan, if I have $100,000 earned income, I can make a $20,000 contribution.
Right.
If I only have $1,000 earned income, I can't make a $20,000 contribution. So you're going to have to show quite a bit of income in order to do this. So you do have to keep that in mind, again, just from a cash flow standpoint.
Right. Yep.
Because if you got a line of credit against that grain, right, you sell the grain, and you're having to fund, a big number, how am I going to pay off the line of credit? Yeah. So you'd have to really communicate with your bank how to do it. Is it really worth it to go debt to fund my retirement plan? How much tax am I really going to save? But again, just know it's a good option if you want to really invest long term in the market, right? If you have other plans for that grain, if you want to buy another piece of land or do something else with it, then this probably isn't going to work, right? Because most likely you're going to put this in, bonds, stocks, something of that nature. So you're really diversifying. You're taking agriculture assets, grain, and putting it into the market. So that's got to be a key thing too, that you're comfortable with the stock market or bonds, and how you want to do it. So it's a lot more than just taxes to consider on this. Right on.
All right, Glenn. Well, plenty of stuff to get ready for the end of the year. So if people have any tax questions, or maybe they found some nugget in here they want to further expand on, how would they get a hold of you?
Yeah, it's best to call our office here at Heinold Banwards. Our phone number is 309-694-4251. You can always look me up on Twitter. My handle is @GlenBirnbaum.
Right on, Glenn. All right, buddy. Well, this is the Moving Iron Podcast, and we are part of the Global Ag Network. So check it out at globalagnetwork.com for more information and how things roll up from there. So, Glenn, have yourself a good Thanksgiving, and we'll talk to you next week.
You too, Casey. Thanks.
Thanks, buddy.